Let's start with the long-term trend. This is how many stocks are going up versus how many are going down on the New York Stock Exchange. Something we like to look at for a big macro trend of the market. Now, the last several months, it's just been not sure. It's been above, below this blue line. Above is generally positive, below is generally negative. But since early January, it's been decidedly lower. And really, when that started, we weren't sure if it was going to be another one of these fake outs because we've had so many of them. But this time, it seems a little more for real, that there is a little bit more fear in the market than normal. Um, Next is our money flow indicator, looking at new highs, new lows, just as money coming in and out of the market. And it's really been messy as well. The drop that we had in January was very textbook and made sense. No reason to be invested for a lot of that first drop. And then once we got past that, it's been just a choppy mess. Things look like they're about to get good and turn around, and then something comes out, like Russia attacks Ukraine, or actually threatens to. Once they decided to, things changed altogether. But I'll get that to a second. So it's just been a really kind of difficult market. But context, big picture, the long term is negative. So we really need to be more defensive, even when we're getting buys at this point. Third, as of last night, the only positive sectors are energy and utilities, although energy is down a lot today. The price of oil is down 10%. I don't know if you saw a few minutes ago. That's crazy. So, and it was just a ridiculous peak anyway. So I don't know if it's going to continue falling or is it stabilizing. I'm not sure yet. It's really early to tell. But really interesting. Last Thursday, see all these red -2 days, -2 days, -3, -2, -2. Those were all positive. The whole market broadly was about to shift over onto the positive side, and we were like, okay, great, we'll start buying in. Let's see how things are going. And then nope. Russia and really the Federal Reserve became issues that really were a little bit unexpected and a little out of nowhere. I'll show you how those kind of played out, right? So that first drop I said was textbook. It was like, okay, we broke here, we missed all this stuff, and then it came back up, and it was like, okay, things might be okay. And then right here, looks like great breakout, and then oh no, Russia's going to attack, and Russia's going to attack. And then what happened once Russia attacked? The market went up 3 days in a row, a lot. I mean, off a huge low and then a bounce. And then right here again, we had money flow. Looks like things are coming back into the market. I don't have my red pen, red laser. Oh, all right here. Market coming back up. It looks like it's going to do okay. No. And I'm not even sure what happened the last couple of days. And yesterday tried, it looked like it was a good rebound. And by the end of the day, it was down. Today is looking like we have another good attempt at a rebound. I'm curious if it holds. Interestingly, the average true range, that's the ATR down here, when that's rising, the market's usually falling. And it's really not rising or falling. It's just choppy sideways. And it was making me think about other bear markets. So I wanted to look at the previous 3 bear markets and look at how they compare to this current price action and see if we can see some comparisons. I thought that was useful. And so back in the COVID crash in 2020, it was a little more of a textbook drop and return, right? We crossed the line here. Average true range was climbing the whole time, right? Little V-shaped thing, and that was it. There was little retracement there of uncertainty, and then it just kept going. And then this kind of played out. True range relaxed, and average true range is really just how much movement is typically happening in the stock market. More movement means higher volatility, means usually a negative market, and lower and relaxing means the market stabilizing and moving up. So kind of keep that in mind as it goes. So the COVID crash was very V-shaped. It was just straight down, straight up, the end, and this worked out really well for us. In 2018, interesting that the Federal Reserve raised rates around this time as well, and what it kind of created. So again, we had this first one. Oh, I believe we missed that. Then you get these peaks. We're like, okay, look, we're going to buy here. Nope. Peak, should we buy? Nope. And then we get a big sell-off, and then we get the V-shape at the end. So it looks like we could be somewhere in this area compared to where we are right now. It's acting like this. And interestingly, the Federal Reserve is about to raise rates in maybe this month, maybe sooner. Who knows when they decide to do it? But that corresponded with the same outcome, because the Federal Reserve raised rates on the 15th of December 2018. That was around here. And then it finally sold off, and I'm not really sure why it recovered from there. And then previous to that, another Federal Reserve was looking at interest rates in 2015 after keeping them flat for many, many years following the real estate crisis. And they just kept rates low for a while, and they started to try to bring them back. And again, the market just kind of ground sideways. ATRs jumped, boom, and then up, and it was a fake. No, and then you get a recovery. Okay, if things look okay, not really. They kind of went down again and did the same thing. So this was just a weird mess. But again, how price action could move based on Federal Reserve movement or their activity. So I'm kind of keeping an eye on this as well as a possible play out. You know, do we get a full recovery back to the peaks and then we have another sell-off, or do we just kind of keep going down like we did in 2018 and then get a good rebound from there? So I'm not sure how that's going to play out yet, but those are the scenarios we're kicking around. A friend of mine, Rob Bernstein of RGB Capital, said that on a presentation he did recently, and that's something we're definitely thinking about. How do we take this time and say, how do we do better going forward, and how do we prepare for a good time ahead? Because there will be a good buying opportunity, and we want to be ready for it. So let's look at those last three all together in context, right? So here's the current situation, right? The green line is the S&P 500. The red line is the junk bond index, and this is a variation on our long-term trend, right? So above the line, things are positive. Below the line, things are negative. So right now, very similar. Below the line up there, S&P is going down. We're not really near crossing back above. The COVID crash, very rapid, and both in its descent and then its recovery. Same thing down here. We can see 2018 was much more of a grind. It was the down, the chop, 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 big V, and then the end. And then you get the buy signal early in the next year and to a great market. And then back in 2015, interesting that the money flow was kind of negative really from mid-year until early 2016. And 2016 started off terrible, if you recall. So that was interesting. And we did actually miss that. We missed this part of it. But yeah, money flow said it was bad. And then once these recover and turn up, you get a good extended run. Could be months of a good market. So no matter what happens with the Federal Reserve, with Russia, we expect that it's going to be shaky for now, and then it should play out into something pretty good in a little bit longer term. And just to show you the drawdowns of these last ones, the COVID crash was 33% on the S&P. This ground down 20%, and that took 3 months to do it. This took about a month, not even that. And then back here, this was about 6 months, and it did about 13% negative. So it looks like it could take a while for this downtrend to wear itself out, but once it does make a turn, I think we'll be ready for that. And of course, in our accounts, we're already largely out of the market at this point. I mean, there's really not been a reason to be invested. So we've been scaling out and out and out, and generally any updraft is a time to sell. And now we're waiting on a good opportunity to get back in when we see positive change in the data.